Today, every financial headline points to the same place: the Federal Reserve, the FOMC meeting, Jerome Powell's press conference. Markets are waiting, commentators are speculating, and millions of investors are watching live. But here's the uncomfortable truth: the market isn't waiting. Wall Street already made its move. In America, the Federal Reserve has become a kind of oracle. Every word is analyzed, every pause is debated, every sentence moves futures. We're told the market reacts to the Fed. But that story skips something critical. Markets don't move because of speeches, they move because of positioning. By the time Jerome Powell steps to the podium, hedge funds have already adjusted risk, banks have already hedged exposure, and institutions have already mapped scenarios. The speech isn't the decision. It's the reveal. Look at what's happening right now. Stocks are climbing. Tech is leading. Risk appetite is returning. And yet, the Fed hasn't said anything. That's because markets don't price the present, they price expectations. Inflation trends, labor market data, bond yields, liquidity conditions. Each data point slowly builds a narrative. By the time the meeting arrives, that narrative is already reflected in prices. The Fed doesn't create the move, it validates or disrupts the story. Every January rally sells the same promise: new year, fresh positioning, optimism resets. Sometimes that optimism is justified, other times it's dangerous. January rallies are powered by belief, not clarity. In 2026, that belief centers on three things: AI growth, strong tech earnings, and a Fed that won't break the market. It feels stable, but stability built on assumptions is fragile. There's a reason big tech often outperforms before Fed meetings. In uncertain environments, capital moves toward perceived safety. Today, that safety looks like mega-cap balance sheets, global revenue streams, dominant narratives. Tech isn't just growth anymore, it's where liquidity hides when conviction fades. That's why money flows there first. Retail investors tend to trade the headline. They wait for the announcement, they watch the reaction, they chase the move. Institutional investors do the opposite. They position early, they reduce risk into optimism, they let retail provide liquidity. The Fed meeting doesn't create opportunity, it exposes who was early and who was late. The real question isn't whether the Fed cuts rates, it's whether the market still trusts the Fed. Markets don't collapse on bad news, they collapse when confidence breaks. If Powell confirms expectations, volatility stays contained. If he challenges the narrative, positioning unravels. That's the risk no headline explains. Professionals don't trade the speech. They watch where leverage is concentrated, which trades are crowded, how markets behave after the announcement. Crowded optimism doesn't fade quietly. It unwinds fast. That's why the reaction matters more than the words. Today, the Fed will speak, markets will move, commentators will react, and headlines will explain it all in hindsight. But remember this: the market didn't wait for the Fed. The market made its decision first. The Fed just shows us whether that decision was right. Next time someone says the Fed moved the market today, understand this: the market moved itself. The Fed just confirmed the story.